Fixed income markets have changed a lot in 2018, 2019. For a very, very long period of time, we had underweighted in our balanced funds, for example, sovereign fixed income exposure, thinking that yields were just too low. They were artificially depressed by whatever risk aversion still existed because of the financial crisis, but probably more importantly by monetary policies, so financial repression. That, in the case of quantitative easing, is no longer a factor, much less of a factor. Rising short-term interest rates have pushed up longer bond yields, and concerns over future inflation have worked in, and yields have now moved quite a bit, over 100 basis points actually, all over 1% in the United States in the last 12 months. And they're actually positioned at a level where for the first time in almost a decade, to say they're probably where they should be. I think over the next 5 years, 10 years, there will be gradually rising longer-term interest rates as the real rate of interest goes back to its 50 or 100-year norm. But that's something you distribute over a very long period of time. At around a 3% coupon, bonds are finally providing investors with a reasonable coupon relative to inflation and a need for a true return on capital. And I think importantly, at the current level of coupon, bonds are providing portfolios a cushion against risk in equities and other risk-type investments. And that really hasn't been the case until fairly lately. So for the first time in several years, we've actually been boosting our exposure to sovereign normal coupon bonds, sovereign bonds.